Hello, and welcome to the Without the Bank podcast, where you and I are going to talk about all things banking and business and money and whatever is on my mind. So, today I want to talk to you about what happens with the extra loan interest, because I don't think I've shared that with you guys. And it is a very common question. So, we're going to talk about that. But first, thank you very much for being here. Thank you for sharing. Thank you for leaving a review. I appreciate it. All right. When we talk or when we read Nelson's book, when you read my book, you hear us talking about being an honest banker, paying back more interest. So, for example, if let's say that you have a credit card debt at 20%. and you borrow money from the policy, why not pay it back at 20%? Now, the life insurance company may charge you 5% interest, round numbers, so you have an extra 15%. Where does that money go? And this is so super confusing to people. Because if you read Nelson's book, Becoming Your Own Banker, he actually illustrates that money going into the policy. So many people think, oh, I can just put that money in the policy. Well, maybe not. It just depends how the policy is structured. You might have to put that money into a savings account. And then once you have enough money to start another policy and do another premium, we can do that. But if we've already paid our full premium, we may not. And here is why. So let's just say that our extra interest is $1,000. But let's say your premium is $10,000 a year. So we're making this $10,000 a year premium payment, and we have paid our full premium for the year. If we set the policy up to accept $10,000 of premium, we can't pay any more than that. Because if we put in 11, it's all going to grow taxable. So we have the modified endowment contract, and we kind of have to pay attention to that. So what happened in the 80s is the government came in and said, oh, hey, you millionaires, you're just, hiding money from taxes and avoiding taxes and putting all this money into life insurance, because you used to be able to do that. You could just put a one-time dump in of money in and never pay tax on the growth. Well, good old government comes in and they get their fingers in the mix and they create what's called the modified endowment contract. That means if you put too much money towards the paid up additions rider and we get cash in there too quickly, it's all going to grow taxable. So what we do is we have to start more policies. So if you borrow money and you're going to pay back an extra $1,000, that $1,000 is not going to go in as a loan repayment. If you've borrowed $5,000, you can only pay back $5,000. You can't pay back 6 as a loan repayment, because remember, they only charge 5% interest, not 15 or 20. So the extra interest then, if you wrote them a check, they would say, oh, thank you, Mr. Customer, for writing us a check, but your policy is full. Your loan is paid back. So now instead of applying that $1,000 to the loan, we'll apply that to the premium. Oh, but I see here that you've paid the full amount. And if we put this extra $1,000 in, it may actually mech the policy, and then it's going to cause the policy to grow taxable. So are you okay if we just send you the check back? Right? You get the check back, and now what do we do with it? Mary Jo, Nelson showed that we can put it in the policy. Yes. Do we want to start another policy for $1,000 a year? Probably not. That's a pretty low premium payment, and you got to be pretty young in order for that to work. So a lot of times what we do is we just put that money in savings, and then when we start the next policy, we use it as a first year where we can put extra money in and we get that overfunded so that we've got more money earning us some interest, okay? And dividends. Now, what happens if I'm not, like, it's going to take 25 years before I start a new policy? Well, if you've got this $1,000 in your savings account, use that like you would your policy. Take it from savings and put it back plus interest. Treat that savings account as if it was a bank. If you have kids, could that $1,000 start a policy on the kids so that now we've got money actually going to policies? Doesn't necessarily matter whose life it's on, as long as you have insurable interest in them. Okay. The other thing that some agents do, and I'm happy to do it as well, is to say, all right, we've got a $10,000 premium, but we're going to be honest bankers and we're always going to pay extra interest at 20%. So we're going to build the policy to hold $11,000. Then when I pay that $1,000 of interest, I have room for it. Well, that's all fine and dandy until your interest is more than $1,000. Because as we borrow money, every year we have the ability to borrow more money. So now we're borrowing more money and the interest isn't $1,000 on what we borrowed, it's $1,500. Well, where do we put that extra $500? We didn't build the policy for that. So where do we put it? Oh, we got to start another policy. So it's going to go into savings. So either way, it ends up to go to a savings account, if we're going to be honest, before we can get it in the policy. So as much as we would love to build that policy correctly from day one, that doesn't necessarily mean that that's what's going to happen. Now, again, most people will say, well, if the policy wasn't built to be an honest banker, we got to put it in savings. Sounds like a lot of work, so I'm just not going to pay myself the extra interest. Okay, that's fine. Whatever turns your crank. But if you don't pay yourself the extra interest and you are not diligent to be an honest banker, what then happens to that extra $1,000? Oh, yes, we go get coffee, we go out to eat, we might buy some different clothes, maybe some jewelry. Right? We tend to not spend it on things that are decent, that make us money. A lot of times it's much easier to take that cash out of there and then never ever have it to front load a policy, because that's when we become dishonest bankers. Okay? So there's really a catch-22, and it really depends on what your personality is, how honest of a banker you want to be, all that good jazz. I personally will just either put it in savings and use it as a dump in, or I just don't kind of mess with it sometimes. It just depends on how much it was. It depends on what I was using it for. Because the extra money is just that, extra money. All this is a play in your head of what you've been taught to think to how we should be thinking automatically. And if we can make that shift and think like an honest banker, we don't necessarily need to be moving money and keeping it compartmentalized. We can do it all at once. Like, I do not keep my personal money compartmentalized. Yet I know clients that they do. They will set up separate checking accounts and savings accounts and clearing houses for money. And that is what makes it easier for them. For me, it's just not necessary. I am just naturally frugal. I am always watching my money. I always have been. And so I know that, okay, I have these bills coming up and this is what this is spent for. And if we have extra money sitting around, do we really need to buy that? Really? Okay, we did go buy that. Let's just say, for example, we bought a vehicle. Okay, we bought that. Now we got to pay ourselves back. I don't need to make notes of that, to be honest, but some of you do. And it's a good way to start if you are somebody that is not a fantastic money manager to begin with. If you are somebody that already has spreadsheets and you already keep your eye on that, yeah, you're probably okay. But this money does not, the big thing here is this money does not automatically just go back into the policy. It can, but it will MEC and all grow taxable. Now, if you're uninsurable, big deal. Who cares? We don't care about a MEC. But ideally, we don't want a policy to become a modified endowment contract because we don't want to pay the tax. When that happens, essentially it turns into and acts like an IRA. Whatever we borrow against or whatever we take out is going to be taxed, and what we put in is going to come out last. So we're always going to pay tax up front. Again, it is not overly a huge thing. A lot of people think it is. It's not. But companies don't like for policies to MEC either. So be honest, but know that whatever you borrow, that's all you can pay back. If the policy is not set up for it, it can't go in. Eventually, it's not going to be able to go in anyway, because we're never going to be able to set up a policy exactly for the future. And sometimes we don't want to set up a policy for the future because that means less cash value today when we need more cash value today. Everybody's situation is going to be a little bit different. Okay, guys, that was short, sweet, and to the point. If you have any questions, comments, concerns, please let me know. I am 100% happy to answer those. You can email me, maryjo@withoutthebank.com, and I will get those answered. Otherwise, go to withoutthebank.com, grab your books, read them, listen to them, whatever you want. They're on audio too. Grab them, listen to them, read them, schedule your appointment, and then we can see where we're going to go from there. All right, guys, hope that you had a fantastic Thanksgiving. I'm a day late, but I hope that you had a fantastic Thanksgiving, and we'll see you in the next podcast.